And I hate that there's confusion over this, but there's a trading letter, and I think we do it here. That's pretty self-explanatory. The investing letter is, I think, where we get into some trouble. What we do in the investing letter, some weeks we make very few moves. Some weeks, if things are changing a lot, we'll make a lot of moves. And some people don't consider that investing. But the reason we consider it investing is what we are trying to demonstrate is sometimes you do have to move your portfolio. Sometimes you do have to change your risk levels to optimize your investment process the most, right? When we make moves, we actually explicitly say they're not meant to be followed. This is our process. And, there's some people that want us to make more moves. There's some people that want us to make less moves. We're trying to manage it on both sides because some people get that it's just ideas that we're presenting, and you can follow the ideas or not follow the ideas. But every time we have an idea, we want to put it out there. And the other thing is we're trying to maximize our returns. We love AMD for the next year. But if we think we're seeing something that we think it could go down, 5-10% in the next week, we're going to get out and get in a better entry point. And we consider that to be efficient investing, right? Another thing that we do, sticking with the AMD example, that confuses some people is sometimes everything will be great with AMD, but NVIDIA will just go higher than it in the signals. We're basically saying we're dropping AMD, we're getting into NVIDIA because NVIDIA is better, right? In that case, especially, we love both long-term. You can pick whichever one you want. We are just saying when we drop AMD and we add NVIDIA that we like NVIDIA better, and we don't necessarily want to keep two chip stocks in our portfolio at a given time. And we think that's demonstrating the best way to optimize your portfolio, which is what we're here to do. Show people how to use signals to optimize your portfolio because we promise hedge fund level intelligence, right? And that's what hedge funds do. Hedge funds are constantly optimizing. They're constantly trying to make their portfolio more efficient. And to be specific about today, what we saw risk assets going up, right? So we added Oklo. We added QBTS. We added ASTS, but then we didn't like that ASTS went from 82 net option sentiment to 74, which, by the way, is a big move in the hour since we entered it. And that's what we always advocate for. If you're a long-term holder of ASTS, that net option sentiment move shouldn't make a difference to you. It makes a difference to us because we could put something else in the portfolio that does have a positive move in that. And that's how we think about it. We got rid of all those stocks. We're not going to hold them just because people are more comfortable with investing portfolios that hold more stocks for longer. No, at the end of the day, we'd much rather have the stocks we already had, Hood, Palantir, that are just higher in the signals than all of them. So we actually think that that's super, super important to make that distinction. We do like all those stocks long-term, the ones that we dropped. We just don't like them today and maybe not the rest of the week. And we'll have to see, how things move with risk assets. But we think that's way more important to teach. Anybody could be take all the stocks that are above 80 and upside breakout, hold them for a year, right? I would watch sector concentration. But when we back tested that, holding all of the 80 or above upside breakout stocks for a year from that moment, it outperformed the S&P 500 80% of the days that we tested in that back test. Great. So if you want some boring thing, right, do that. Hold all the stocks above 80. But we're here to teach people how to become better and how to optimize that. If I got up here every stream and was just okay, we just got everything above 80 in our portfolio, we're holding above 80 upside breakout for the next year, that would be pretty boring. And the returns wouldn't be nearly, you don't beat the market by 80% by holding, a basket of stocks for a year. Could you beat it by 10%? Could you beat it by 20%? Absolutely, right? But we are trying to show people how to beat the market significantly.